Hi, my name is Todd Jordan, Managing Director with Hedgeye Risk Management. Today I'm with Brian McGough, who heads up our retail effort here at Hedgeye. And Brian, I think last time you and I were on Hedgeye TV together, we talked about JCPenney as well as Kohl's.
That's right.
And as I recall, that was pretty close to the peak of Kohl's, and the stock went straight down. Now it's come back up recently, and I know you've been active on the name recently. So what's going on with Kohl's?
Well, so I didn't like it back in November, and I didn't like it after it fell. It has come back, and I absolutely don't like it now, and there's a lot of reasons why. So I can't hit on all of them right here, but I think a couple of key points. One is that they're having a really hard time comping. So there's a chart we have here, and it shows that over the past 9 quarters, the store comps have been negative. I've never seen a retailer do that. I think Sears may have done that at some point, but I mean, that's really hard to actually pull off, and these guys have done it. The one thing which has saved them has actually been their .com business. And when you look at the trend in their .com business, I think I have another chart on this, it actually shows that it's just been dropping like a stone. So the one pillar of support is actually really eroding very, very quickly.
Wow. So .com historically been very, very good for them. It's no longer good. So is there any bright side to the story? I know you've been negative overall on retail, so you've got a lot of shorts, and this is probably one of your strongest shorts, but is there anything to be optimistic about?
I mean, there's always a couple of things you could point to here. Unfortunately, with Kohl's, you've had square footage growth in the past. Now you've got a no square footage growth retailer that can't comp. So that means revenue overall is going down. I mean, the biggest point here, and I'm sorry, I'm going to have to bring you back to a negative here, is that they actually took about $800 million away from JCPenney. No one really recognizes that, but it's a really big deal. And you've got JCPenney, they are powering back. And a lot of people don't like JCPenney, and that's fine. But whether they actually take that share back or not, they're going to do a lot of damage here. So Kohl's guided to a flat to +2 comp over the course of the upcoming year. They will not do that. They will comp down. And that's the point that I'm hammering home.
Well, I remember that was a big part of our discussion was, what is your survey work telling you about JCPenney? And you brought up that they're taking business away from Kohl's. So they're getting hit twice here. The macro is terrible for retail,
awful,
the overall environment. And then also, they're losing share directly to JCPenney. Do you see that abating at all?
No, not at all. It'll accelerate over the course of not even just like a month or 2 or 3. It's going to be like a 2-year call. So I would just avoid Kohl's at all costs.
Wow. So in a sector full of shorts, Brian McGough is highlighting yet another one with Kohl's. And if you want to learn more or communicate more with Brian, you can tweet him at Hedgeye Retail. For that, I'm Todd Jordan. Thanks again for joining us.